Hi, hello, welcome friends. In this video we are going to discuss about CA Finance chapter 11 International Financial Management. So what is there in International Financial Management? So after completion of this International Financial Management, we will get to know about the internal capital budgeting, raising funds from international source and sovereign funds, and internal financial center, that is gift city related, and internal working capital management, which has internal working capital management, multinational cash management, multinational inventory management, or multinational receivable management. So these are all the concepts. We will get idea of that these concepts at the end. So first we need to know about internal capital budgeting. Here, what are the complexity will be involved, what are the problems will affect for foreign investments, so what are the projects will be there for parent cash flow. So for adjusting the cash flows we have different methods will be there. So we will discuss about these cases here. Firstly, what are the complexities will be discussed for multinational capital budgeting. Here the different factors would be considered and variables would be considered for foreign projects and complexes in the nature of then domestic projects. So for domestic projects, if you take in any domestic project, there may be more complex is there when foreign projects is taken. Then the factors may be different factors will be there and variables will be there. What are the factors, crucial factors for these situations will be: firstly, the cash flow related for foreign projects have to be converted into currency of the parent organization. This is one factor which will influence and whereas the parent cash flows are quite different from the project cash flows. So we are taking one project and this project cash flows are different from where parent is registered. So if US is the registered firm and we have started one project in India we have rupees, and whereas parents it has US dollars. Next, profits are remitted to the parent firm are subject to tax in the home country as well as to the host country. So we need to pay tax in the base of accrual amount accrued in income, and there they will pay based on their resident. And effect of foreign exchange risk on the parent firm's cash flow. So whenever we are converting, if the USD dollars was down, it will parent will pay the loss. The risk will be there, foreign exchange risk will be there. So firstly what we are discussing, cash flow risk, and there may be different in cash flows will be there and tax issue will be there. And after that foreign exchange risk, so money exchange foreign exchange risk will be there. After that, changes in rate of inflation causing shift in the competitive environment and thereby affecting cash flows. So another one is inflation risk will be there. So after that, restriction imposed on cash flow distribution generated from foreign projects by host country. Sometimes for example, if we countries is there, Japan and Ukraine and Russia, I think, Russia and Ukraine, they are in war, so they don't allow to the exchange of cash flows, it will not allow. Next, initial investment in the host country to benefit from the release of blocked funds or political risk in the form of changed political events reduce the possibility of expected cash flows, and concessions benefits provided by the host country ensure the upsurge in the profitability position of the project foreign project. And estimation of terminal value. So what is the estimation of terminal value in multinational capital budgeting is difficult since buyers in the parent company have divergent views. So what are the all crucial points we are discussed? First one is cash flow. After the cash flow we have different cash flows will be there, we need to convert this, and for the conversion we have foreign exchange risk. After that we have discussed about inflation risk will be there, and after the inflation risk we are discussed about distribution will be happen. So there may be sometimes it may be restrictions may happen, and another one will be initial investment risk will be there, and after that political risk will be there. So the parties may different, and some concessions or benefits problems will be there, and estimation of TV, that is termination value problems will be there. These are we discussed. Now what are the problems affecting foreign investment analysis? So there are various types of problems faced in international capital budgeting analysis. So we are discussing the above the problems. So for analyzing that also we have different problems. So what are the problems will be there? MNC is there, restrictions is there, MNC capital budgeting. So firstly MNC, that is multinational companies is there na, this will invest and they will have foreign exchange risk. So when multinational companies were investing, they have subject to foreign exchange risk will be there, and there may be currency may appreciate or currency may depreciate. So that's over a span of time. Here the foreign exchange risk, the company must estimate the cash flows of any project. They will estimate the cash flows. So for that they need inflation rate will be considered. So from real cash to nominal cash to real cash, for that they will need to include that inflation rate during the lifetime of the project. So adjustment of inflows in the cash flows will be required to depict the local currency. So cash flows are converted pair in currency, spot exchange rate will be required. So spot exchange rate, what is the spot exchange? This is we discussed in first point. So what is the point? Multinational company, alas where he is subject to foreign exchange risk will be there, and currency appreciation depreciation will be there, and risk will cash flow estimation of any project, and it is required inflation rates are during lifetime of project. Adjustment of inflation will be required. It will become nominal cash flows to real cash flows to nominal cash flows. It will expected depreciation rate obtained from the purchasing power parity. So purchasing power parity, triple pay. Next second point, here we have some restrictions will be imposed to transfer the profits. So to transferring the profits, and we need to calculate the depreciation charges or terms technical specifications will be there for the projects or cash flows. So the organization must maintain some restrictions may imposed for diluted by the application techniques or internal transfers like prices, overhead payments, adjustment for blocked funds depends on the its opportunity cost. A vital issue is capital budgeting process. So here some due to restrictions are imposed on transfer of profits, depreciation charges, and technical specification. There may be different will be there where projected cash flows and actual cash flows obtained by the entity. So in the projection cash flow we will assume this will happen, this will happen, this will happen, but at reality they may not happen. So there may be dilution will be happen. For overhead payments will be internal transfer prices, adjustment for blocked funds. Here blocked funds means what? So blocked fund means in the funds we have four types of fund will be there. One is master fund, another one is feeder fund, another one is parallel fund, another one is blocked fund. So blocked fund, what is this master fund? Where the fund is registered in the main area, it is known as the master fund, and other name is onshore fund. Where has feeder fund, this will offline fund which will register in small areas where other divisions of this division just they will pool the money and they will feed the money. So they will pool the money from investors, they will feed the money to master. And where has parallel fund? So in master fund we have LPA agreement, that is limited partnership agreement. For that limited partnership agreement we have some objectives. So this master fund will follow that LPA terms and conditions. So when it has one objective, for example it has a real estate objective, so now this want to go in enter into infrastructure. For that infrastructure they will register another one which will equivalent to mutual fund, this is parallel fund, and another one will be block fund. So block fund means here the mutual fund, here they need to pay the tax as basis of resident. Where company is registered in another area, they will need to pay based on their resident, they will be paid based on source basis. So it is they need to pay more tax. If the company has, here in this case if the companies have any DTA agreements or tax free country is there, then they will register one block fund. So block entity, they will create the block entity, then they will get the benefit of the tax free or DTA agreement. This is they are discussing here. So block funds depends on the its opportunity cost issuing capital budgeting. Next third point, in third point what they are discussing now, I think so, just a second. In third point the MNC, what is the PAT, that is profit after tax, what is that there. So for the project evaluation key, what is the profit after tax? Here for this we have two tax regimes will be considered for remittance of funds, and for this in income tax, we need to discuss about that relating to royalty or dividends or management fee, etc. They need to withhold a tax, that is TDS provisions will be applicable held in the host country. Now present some this DTAS will consider double taxation avoidance or tax registries or tax determinations by the host country between when the transfer is related to the profits local or their reinvestment in such profits in serious immediate to MNC. So MNC position is they need to reduce overall tax burden through system of transfer pricing. This is the third point. So in third point what they are discussing MNC multi-capital budgeting. After the tax cash flows means profit after tax need to consider from project evaluation. So they need to evaluate the project. Here they have two tax regimes along with other factors such as remittance to present form in the nature of royalties, dividends, management fee, etc. Withholding tax provision, that is TDS provisions with the held in the host country, presence of tax receipt, tax discrimination pursued by the host country between transfer of realized funds, vice versa, local reinvestment of such property. So they may transfer that realized profits or they may reinvest that profits. It will cause the serious impediment to MNC multinational capital budgeting process. So MNC are in position to reduce overall tax burden through the system of transfer. I think for computing this after tax flow, that is profit after tax flows occurring to the parent firm, here higher home or host country tax rates are used. If the project becomes feasible, then it is acceptable under a favorable tax regime. So if not feasible, then other tax saving aspects need to be incorporated in order to find out whether the project crosses the hurdle rate. So here the hurdle rate means what? So hurdle rate means this is one benchmark rate. So benchmark rate which is ideal one. So this is one benchmark rate, and in hurdle rate we have two types of hurdle rate. So it may be hard hurdle rate or it may be soft hurdle rate. In hard hurdle rate what happen? In hard hurdle rate, when the cash flows exceed some benchmark rate, then on the exceeded amount, then they will transfer that cash flows. For example, they are telling hard hurdle rate will be 10%. So firm means this company raised the capital means they earn the profit 20%. So they exceeded 10%. Benchmark rate is exceeded. So above amount how much they are exceed 10%. So this 10% will be transferred to parent. And whereas soft hurdle rate means, for example, here also 10% is there, and here 15 or 20% was exceeded. So amount is exceeded na, so all amount will be transferred to this parent firm. This is hurdle rate they provided here in hurdle rate. So project may be crosses the hurdle rate. Next, project vice versa parent cash flows. So whatever the projected means what we are projected, what we projected, and what is the parent cash flow. So there may be big difference will be between project and parent cash flows due to some tax rules, exchange controls, and management and royalty payments returns to the parent firm. So the basis on which a project shall be evaluated depend on one's own cash flow or cash flow accruing to the parent firm or both. Now we need to evaluate the project based on the own cash flows. So entail that project should be compete favorable with the domestic firm and earn the higher return. So for to get the higher return, we need to ensure our own cash flows. So if you are borrowing more money or you are investing in this, you are paying interest amount, so then the cost will increase. When cost is increasing, profit will decrease. So for the projects we need to ensure that we are using our own cash. It is better investment. And for the domestic firms and earn the returns higher the local competitors. If not the shareholders, whoever the shareholders, they will go with them. So comparison cannot be made since foreign projects replace import and are not competitive with the existing local firms. So project evaluation based on local cash flows, avoid currency. Now conversion and eliminate the problems associated with the fluctuating exchange rates changes. For evaluating that, so for the evaluation of the project on the basis of own cash flows, so the parent firm angle both operating and financial cash flows. So in cash flow statement we have three: one is operating, another one is investing, another one is financing. So we need to compare this one. So we need to see in both sides what is actually remitted, what is projected at the time of projection is therefore. So we need to consider both. After that, discount rate and adjusting cash flows. So for valuing the price we have one method, we can use this discounted cash flows. So all the cash flows will be present valued, means discounted at present value. It will discount rate and adjusting cash flows. An important aspect in multinational capital budgeting is to adjust cash flows or discount rate for additional risk arising from foreign location of the project. So earlierly MNCs adjusted the discount rate upwards for riskier projects had they consider uncertainty in political environment. So what are the uncertainties will be there in political environment, they will consider. This is very riskier when project is starting. This political parties is there, the political parties may ask some money, so it is risk for the companies to start new startups. So these MNCs will consider the MNCs consider the adjusting discount rate to be popular rate of the project should be conformity with the degree of risk. So what is the risk is there, for that they will consider the discount rate. It is not popular to combine all risk into single discount rate, so it is not proper some cases. And political risk and uncertainty attached to the project relating to possible adverse effect which might occur in the future but cannot be foreseen at present. So for political risk we cannot see as of now, but it will affect when the project is started. So at the starting the government also give all permission for in between of the starting we are invested some amount, they will ask money also. So then it will get the more problem. So adjusting discounting is not possible in some cases, and some cases risk of penalize the earlier cash flow, more distance cash flows will be happen. So for discounting rate offsetting the exchange risk only when adverse exchange rate movements are expected, not proper. So since these MNCs will gain from favorable currency movement during life of the project on many occasions, so they will see the what is the cash flows will be there instead in adjusting the discount rate considering, because why this project amount was different from actual, they are discussing, they have different risks, so that they have different amounts. So then annual cash flows are discounted at a rate applicable to the project either at the host country or parent country. So probability with certainty equivalent method along with the decision tree analysis are used for economic and financial forecasting. So cash flow generated by project and remitted to the parent during each period are adjusted for political risk, exchange risk and other certainties. I think just a second here. Now we need to know about the adjusted present value. What is this adjusted present value? When in past days we will calculate the NPV na, that is NPV, that is now adjusted PV is used to evaluating foreign projects. The APV model will additive approach which is to capital budgeting process. So here for each cash flows we need to consider individually, and discount is at rate consistent with risk involved in the cash flow. If it is relating to real estate, one rate will be considered. If it is relating to infrastructure, we will consider other rate. If it is relating to electronical vehicles, we need to consider other rate. So based on the individually cash flows, we need to consider individual discount rates. So different components of projected cash flows have to be discounted separately. Now APV method uses different discount rates for different segments of the total cash flows, so depending on the degree of the certainty attached with each cash flow. So the financial analysts test the basic viability of the foreign project before accounting for all complexities. So So if the project is feasible, no further evaluation based on the accounting for other cash flows is done. Now if it is not possible, an additional evaluation is done taking into consideration the other complexities. Now the APV model will represent as follow. They are given one formula. So one formula, what is there? Firstly, present value of investment outlay. So whatever the investment outflow means cash outflow, we will deduct, and after that we will add present value of all inflows. So XT means that is one present value of operating cash flow, and TT means present value of interest tax shield, present value of tax subsidies. So whatever the inflows, we need to add this all inflows. This is one outflow. So it is like as present value of cash outlay, this is minus, and plus present value of cash inflows, and we will get the APV. In past we have no NPV. If it is positive, we will accept the project. If it is negative of NPV, we should not accept the project. That is the case they are providing. The initial investment will be net of any blocked fund that can be made used by parent company for investment in the project. So blocked funds are balance held in foreign country that cannot be remitted to parent due to some exchange control regulation. So blocked fund means I have explained now, where tax free, there they will give one, they will create what they will register as one blocker entity. So they will not exchange cash flows simultaneously, and they have some quite possible that significant cost in the form of local taxes or withholding taxes arise at the time of remittance. So if you are remitting the amount directly, they will need to pay the amount. So such blocked funds are indirect. If parent company release such blocked funds in one country for investment in overseas project, so then such amounts will go reduce cost of investment outlay. The last two terms are discounted at before tax cost. So we will use the discount rate before tax cost, and relative cash flows will be considered to tax and tax savings. Next, they provided some scenarios. Following three illustrations are based on three different scenarios. I think illustrations are problems and testimonial questions we will discuss in one video. It is better. For illustration we have three illustrations they are provided. I will discuss these illustrations and test your knowledge questions, whatever the question. So questionnaire is we will give in one video. Better, it is better. So first, now we will go with the conceptual wise. So first we need to know about the conceptual. I think third one. Now here. So second topic will be internal source of finance. What is there in international source of finance? Here the companies will have been able to tap global market to raise the foreign currency fund by issuing the various types of financial instruments. So if you want foreign money, for that foreign money you need to use foreign currency bonds, foreign currency papers, foreign currency shares, foreign currency certificate, then you will get the foreign amount. So you are using international sources of finance. So for company, it has source of finance means equity or debt. Now for debt we are using international wise. What are the instruments, financial instruments will be have? So firstly we have foreign currency convertible bonds, that is FCCB bonds. Here this is a convertible bonds. It is one is convertible bond. So here there is in currency convertible bond issued in a currency different than the users domestic. So they will use foreign rate here. So now okay, foreign rate used there here. And in other words, money being raised by issuing company in the form of foreign currency. So for example, HB company is there, they are issuing in foreign currency one bond. It is known as foreign currency convertible bonds. It may, but this bond may have mix of debt equity, that is instrument. It acts like bond by making regular coupon and principal payment, but this bond also give the bondholder the option to convert. So it acts like, so but debt means we need to pay the interest, and at the maturity we need to pay the principal. So it will act like as a debt, and they also provide the option to convert into equity. So if you went for the equity, they need to pay the dividend. That is the concept of foreign currency convertible bonds. These types of bonds will attract both the person who are investors is there, they will attract that person. For issuers is there, they will attract this persons also. And here the investors who is the persons want some guaranteed amount, so they will go with this because bond will pay regular interest. Then who want guaranteed amount and also take the advantage of large price. If the company's stock price is increased na, then he can convert and he can sell and he will get the capital appreciation amount. So he will get the both advantage also for this. So due to equity size of the bonds which add value to the coupon payment, is there it will reducing the debt financing. What are the advantages there for this bonds? So for future foreign currency convertible bond, what is the advantages for these bonds? So advantages means these bonds give flexible to convert. So they are providing debt as well as equity, so at the price. So they may redeem at the bond at the end of the specified period, or they may redeem if they want. If share price is not going up, or they are thinking their share price is not going up, then they can sell, they do not have any problem. And company prefer bonds as it leads to delayed dilution of equity, so allow company to avoid any current dilution in earnings EPS that further issuance of equity would cause. So why they will go, if they issue bond na, it is better. If you go for more equity na, that EPS will be there na, EPS will be diluted, so it will be diluted. Next, after that advance for FCBV. So here another advance will be company, it has easily marketable because it is in foreign currency convertible bonds na, it has more market and enjoy the option. So it has more marketability means the equity price may have chances, so they may use the option if conversion is appreciated. This is advantages will be there. Firstly, the advantages means firstly it will provide the flexibility and it will delay the dilution of equity and easily marketable. Next, what are the disadvantages? So for disadvantages we have, first disadvantage will be risk is there more because it is foreign currency bond. Interest on the bonds would be payable in foreign currency. So if company has low debt and low debt or equity ratio, then these have large forex earnings potential only opt for only the company which have large forex capital, they need to use these options because all companies are not able to pay amounts. Then this create more debt because they are buying and also giving the options. Next, another one will be they are providing this convertible bond na, so interest rate low say, but there is exchange risk will be there. Even though interest is low, the exchange risk will be there. So payment year repayment is there if not converted. If the company that investors is not redeemed, if they redeem the amount, they need to pay the earnings whatever the amount. And other major advances, whatever the high rate earnings and conversion take place subsequently the cases. So firstly, what is the disadvantage? One is disadvantages will be relating to FCB interest on bonds will be low debt, equity is not possible to use this one and create more debt, and convertible bond interest rates are low but payment as well as repayment not convertible into equity, they need to pay the amount, then they will have forex problem. And these are the disadvantages. This is foreign currency convertible bond. After that foreign currency convertible bond, we will discuss about American depository receipts. So what is there in ADRs? Will naturally call as ADRs. So here ADRs. What is this ADR? So ADRs means depository receipts issued by company in the USA. So where depository issued by company in where they can issue USA and is known as American depository bonds. So depository company is there will issue in USA, then it will be known as ADRs. Here the amount such receipts must be in accordance with the provisionally stipulated by the SEBI. So whatever the terms and conditions, they may follow SEBI conditions only. And USA SEBI conditions means their SEBI, that is SEC of USA. So they need to follow their here very stringent, where ADRs are generally created by the depositing of securities of non-US traded companies with a custodian banks in the country. So for this means this depository banks. So for example, one Indian company is there, so they want to raise capital from foreign. So in USA they need to issue ADRs. So for issuing these ADRs they need one person will be required. So another person they will use one person. This is the custodian's bank. So they will give the shares and they will issue the shares. This is ADRs to this case, and they will get the money and they will distribute the money. This is the process will be there in here. So the custodians of the bank inform the depositors in USA, United States, that the ADRs can be issued. ADRs are United States dollars denominated and traded in the same way as the securities of invested company. For example, an Indian company Reliance Jio is there, that Reliance Jio wants to issue in USA, then they will meet the custodian, they will give the shares, and the custodians will use the ADRs will issue. Several variations on ADRs have developed over a time to meet more specialization demand in different markets. One such variations are GDRs. So we will discuss GDRs also. So firstly we will see the ADRs in what is they provided in ADRs. Depository is issued by the company in USA where they can use USA. They use no, then it is known as ADRs. So such securities are issued in accordance with stipulated of SEBI USA, which were very stringent, and created by deposit of securities non-US company, means other than USA company they are issuing in USA market. So for this purpose, incorporation of issuing company with a custodian bank, so they will use the help of custodian bank. The custodian bank inform the depository in the United States that ADRs can be issued. ADRs is United States dollar denominated and are traded in the same way, where advantages of owners underlying securities home country. Several variations will be there. We will use the GDRs. Now what is the GDR? Means global depository receipts. So I will explain here. So GDR means global depository receipts. What is this global depository receipts? Here depository receipt is basically negotiable certificate, one certificate. This denominated in currency not native to the issuer, means in ADR we went to for USA na, this is ADR means we went United States of America. Now the Indian companies want to issue in different companies globally, then they will issue the ADRs, means for this purpose. So company GDRs we are discussing. Company is Indian company, they want to issue in other than USA, for example Japan, Russia. So then this Indian company with the custodians, they will issue the GDRs. This is globally depository receipts. So globally means global wise we can utilize these deposits. Here depository receipt is basically negotiable instrument denominated in currency not native to the issuer. Issuer means our Indian company. So Indian company rupees is there, so in rupees they are not issue. That representative company publicly traded local currency means USD, that is USD is the publicly traded local currency equity shares. Most GDRs are denominated in USD, while a few are denominated in euros or and pound sterling. So the depository receipts issued in the US are called as ADRs. Means if you go with the USA, it is American depository receipt. If we go with the other market, this is GADRs. So we can, which anyone can denominated in USD or outside a USA, this is called GDRs. So if you issued in USA in USD, it will be ADRs. If you use this USD in other countries, it will become the GDRs here. And in theory they are, so depository receipt can also represent debt instruments. In practice rarely does. So these depository receipts are created local currency shares of an Indian company or delivered to depository local custodian banks. So Indian company they will transfer our shares to one custodian. This custodian will issue in that country, and the depository bank against the bank, the maybe Bank of New York issues depository receipts in US dollars. The depository receipts may trade freely overseas market like any other dollar denominated security, either on foreign exchange, stock exchange, or in OTC over the counter market, or among a restricted group such as qualified QIBs will there, or Indian issues have taken the form of GDRs to reflect the fact that they have marketed globally rather than in equity, rather than in specific country or market. Through the issue of depository receipts, company in India have been able to tap global equity market to raise foreign currency funds by way of equity. So quite apart from the specific needs that the Indian company may have equity capital in preference to debt and perceived advantages of raising equity over debt in general. So there is no repayment of principal and general lower servicing costs. So the fact of the matter is quite simple, that no other forms of term foreign exchange funding has been available. So in addition, it has been perceived that GDRs has been able to fetch higher prices from international investors. They will use in domestic public issues. Now what are the impacts of this GDRs and capital in Indian markets? So here, for inception of GDRs, remarkable change in Indian capital market has been observed. What are the changes will be happened when GDRs is issuing? One is Indian stock market to some extent shifting to Bombay. So Bombay to Luxembourg. So Luxembourg, the market was shifted. These are using arbitrage probability. So arbitrage they are using for arbitrage purpose. So I will write here. So market was shifted to Bombay to Luxembourg. First impact. Second one, here arbitrage possibility, therefore this GDR issues. And after that, Indian stock market have no independent for the no independent from rest in the world. So this puts additional strain on the investors, as they no need to keep updated in the world. So because there is no, we need to update fastly, dynamic change. And Indian retail investors who are there in this silence, these GDRs or foreign institutional investors, who is the persons will be there now, they need to placements plus free pricing will be happen, can no longer expect to make easy money on heavily discounted rights or public issue. So as a result of introduction of GDS, consider foreign investment has flown into India. This is the advantages will be impact will be happen. So shifting from Bombay to Luxembourg, arbitrage possibility, and no longer independent from rest of us. We need to update worldwide information, and Indian retailers completely silent. So the institutional investors come into picture, heavily discounting rights or public issue. Next up, market of GDRs. So what is the market of GDRs? Here GDRs are sold primarily to institutional investors. So whom they are selling, institutional investors, who is the person able to buy, that person will be buying, and demand is likely to dominated by emerging market funds. So switching from FII, foreign institutional investors, from ordinary shares into GDRs is likely there. And major demand is also UK, USA, qualified institutions, Southeast Asia, that Hong Kong, Singapore, that persons are using this type. What is the mechanism? for GDRs issue, firstly, company will issue ordinary shares to some custodians will be there. These custodians will issue GDRs to these foreign institutional investors. Now characteristics. What is the characteristics? Will be there for GDRs. Holders of GDRs participate in the economic benefit of being ordinary shareholders through they do not have voting rights. GDRs are scheduled through CIDL or Euro Clear International Book Entry System. Now GDRs are listing on Luxembourg Stock Exchange because they are listing in Luxembourg Stock Exchange. Our Bombay market is shifting to Luxembourg. Next, another one is trading takes place between professional market maker on an OTC, that is over the counter basis, and trading taken place after that instruments are freely traded, and whereas they are marketed globally without being confined to borders of any market or country, as it can be traded in more than one currency. Next, investors can earn fixed income by way of dividends which are paid in issuer currency converted into dollars by depository and paid to investors, and hence exchange risk is with investors. As far as the case of liquidation, if the company is in liquidation of GDRs concerned, and investors may get GDRs will be cancelled. So any time after cooling period of 45 days. What is the cooling period? 45 days will be the cooling period. If a non-resident is the holder for GDRs, may ask the overseas bank, that is depository bank, to redeem, that is means to cancel the GDRs, and in that case overseas depositors bank shall request the domestic custodian to cancel the GDRs and they get the corresponding underlying shares related in favor of non-resident investors. So if they want redeem, they can redeem. They will ask the respective persons and they will get the amount. The price of the ordinary shares of the issuing company prevailing in Bombay Stock Exchange or National Stock Exchange on the date of advice redemption shall be taken on the cost of acquisition of the underlying ordinary shares. They will consider our market rate will be considered. After that, illustration 4. So I will discuss this all questions at one time only. Better. Next, euro convertible bonds. So what is there in euro convertible bonds? ECB. So firstly we are discussed about foreign currency convertible bonds. After that we are discussed about American depository bonds. After that global depository bonds. Now we are discussing about euro convertible bonds. What is this euro convertible bonds? Here the convertible bonds is debt instruments. What is this? Debt instruments which give the holder an option. Option means what? A right but not obligation. So what is the option here? Either converting bond into predetermined number of equity shares of the company. So as usually this price of the shares at the time of conversion will have premium. So they are giving the option now. For option means it is a right but not an obligation. So for to get that option you need to pay some premium. Then the bond carry a fixed rate of interest. If the issuer company desires, the issue of such bonds may carry two options. So they may go for the call option, they may go for the put option. Call option means issuer's option. So issuer means here who? Company. So call company. So call company will issue. So call means we have the option, company is the option. Where here terms of issue of the bonds contain a provision for call option. The issuer company has option of call buying. So here call means company have buying option. So buying option of the bond, redemption before maturity. So for example, if company does not have money, they issued one bond. That bond contains 3 years maturity. After 1 year, company become more profitable. Now company thinking, why should we pay the interest? So at the time if they want redeem, they can redeem immediately. They can ask that person, give that bond, I will redeem the amount, so I will repay the amount. Then the person will need to pay because the company has the option, they need to pay the more amount. Here where the issuer share price has appreciated substantially, that is for the exchange of the redemption value of the bond, the issuer company can exercise the option. This call option forces the investor to convert the bonds into equity. As usually such case arises, the share prices reach a stage nearly 130 to 150 of the conversion price. Next, put option. Here a provisions. Put option means A provisions of put option give the holder of the bond a right to sell his bond back to the issuer company at a predetermined price and date. In case of euro convertible bonds, the payment of interest on and the redemption of the bond will be made by the issuer company is US dollars. Now, some other sources of bonds. So firstly we are started with foreign currency convertible bonds, AGRs, GDRs, and we are converted euro convertible bonds. Here euro convertible bonds we have two options. One is call option, one is put option. Call option means company get the right, and put option means this buyer will get the right. Company getting the right, so interest rate is high, where put option means buyer getting the right, so it does not have the more interest rate, and they in both cases the premium will be payable by the buyer who is buying, and the person in put option, the buyer whenever he want money he can get money from the company. Put option. Next other bonds are euro convertible bonds. So euro convertible zero coupon bonds. First of all, what is zero coupon bonds? Zero coupon bonds we need to identify. Zero coupon bonds means here issue at discount. They will issue at discount, and they will no interest will be payable, and redeem at fair value. So this is the main zero coupon bonds. Means here they do not have amount. For example, zero coupon bonds will issue at discount, and they do not pay any interest, and they will redeem at face value. But here the what is the main issue? Here issuing at 90 rupees issuing at 90, redeeming it 100 rupees. There is different is 10 rupees. What is this 10 rupees? Different is it is profit or interest. It is profit or interest. Is it considered as interest? It is not a profit, because and here we need to account this 10 rupees in amortized basis. Amortized basis means the bond is 10 years. No, not 10 rupees will be considered, divided by 10 is equal to 1 rupee, means every year we need to accumulate that 1 rupee to the bond. So what are the general entries? For first we are investing the bonds investment account debit to cash. So investment bond account debit to cash, and after that we need to accrue that, we need to increase that asset investment in bond debit to interest income. We need to accumulate that interest. At the end we will get the full amount. We will not consider that different amount as profit. So if it will become the profit, at the end we need to pay the more tax. So if we consider interest, every year we are accruing, tax burden will be less. That is zero coupon bonds. If it is euro convertible means they are also same. The bonds will be structured convertible bonds, which they do not have pay any interest, but they provide the conversion option. And euro bond with equity warrants. Warrants means this will purchase, this person's shareholders will get the shares, means same as convertible bonds, but convertible bonds will have option to convert bonds at the time of redemption. But if you buy the warrants, you need to purchase, you do not have the option, but the price will be less price as compared to market price. These are purely bonded are traded at discount. Fixed income funds may like to invest in these bonds for the purpose of regular income. Next, syndicate bank loan. Here it is one of the earlier way of raising bonds in the form of large loan from bank with a good credit rating. So credit rating means who will give the credit rating? This CRESI or Moody or CRISIL companies will give the credit rating. The AAA plus or B category, B grade or C grade, they will provide the ratings. If the company has good rating, then risk is low, and here reasonable short term and few formalities will be there. For maturing loan can be durable 5 to 10 years, and interest rate will be set reference as index or LIBOR plus 2%. They will use the different interest rate. Next, another one will be euro bonds. Euro bonds means these are basically debt instruments denominated in currency issued outside the country that currency. So here we have one debt instruments. this will be denominated in currency other than home currency, that is N bond floated at French in France. So primary attraction of these bonds is refusal from tax or regulations and provides scope of arbitrary use. These are also known as the masala bonds, where we can issue in other country the different rates. Traditional fixed rate bonds or floating rate notes or convertible bonds. Next, after that, foreign bonds. Foreign bonds means these bonds denominated in a currency in which foreign to the borrower and sold at the country of that country. So if we are issuing of the same country currency, it will foreign bonds. If you are issuing other than that currency, it is euro bond. Next, euro commercial papers. Euro commercial papers means it is like as our money market securities, which are short term securities, which are short term means less than 1 year will be there. Next, credit instruments. Here credit instruments means the foregoing discussion relating to foreign exchange risk management and international capital market show that foreign exchange operations of bank consist primary purchase and sale of credit instruments. So there may be type of credit instruments used in affecting the foreign remittance. They differ the speed which money can be received. This is relating to in amounts, different types of bonds. So this is new concept, that is international financial center. This is gift to city. This gift to city is new concept which is created now. IFC centers or nowadays this IFC was created, where this IFSC means that financial center that caters to the needs of the customers outside their own jurisdiction. So some persons will go in some jurisdiction, then that customer needs some financial services. This financial services is cleared by these companies, investment international financial center. It is like as a bank. So wherever you can go, you can use the bank services. Same as this bank, some center they will give the permission for giving the money and taking the money. It is like as a ATM only. And broadly speaking, IFSC is hub that deal with flow of funds or financial product or financial services, even to own land but with different set of regulations and laws. Now thus these centers provide flexibility in currency trading, so they can use this currency tradings, and they can give insurance, and they can give banking service and other financial services. So this flexible regime attract foreign investors, which is potentially benefit not only to the stakeholders but as well as for the country hosting IFC itself. Now what is the benefits for IFC? Here there are numberless direct and indirect benefit will be there to setting of IFSC. For major will be, firstly, opportunity for qualified professionals. We the persons is there na qualified professional working outside India come here and practice their profession. So firstly they will benefit for this qualified professional, and a platform for qualified and talented professionals to pursue global opportunity without leaving their homeland. So without leaving India, they can perform international wide opportunities will be there. Stop brain drain from India. I don't know. Bringing back those financial service transactions presently carried out abroad by overseas financial institution entities or branch or subsidiaries of Indian financial market. So whatever the financial services is located in outside country, now we will take in come back to India. Next, trading of complicated financial derivative can be started from India. So for derivative means it is a one financial contract which the value will be derived from the underlying assets. Now constitution of IFC means International Financial Center, other name is Gift City. How can we constitute it IFSC? So firstly, there are many constitutions for IFC, but some of important constituents are: first, highly developed infrastructure. We need to lead hedge infrastructure is prerequisite, so more infrastructure will be required to offer international competitive financial services. Next, stable political environment will be required, so eagerly changing the government, that it also affect the IFSC. So destabilization political environment bring the country risk for investment by foreign nationals. So if the country that foreign nationals is there, they will invest by seeing the present government. Next, the government was changed. The government will implement some restriction to that persons who are invested in past government. So this is will create the problem for this IFSC or green cities or strategic location. The geographical location of financial centers should be strategic, such as near to airports, seaports, should have friendly weather. So they need to give the location relating where the foreigners is coming or going. And quality life, the quality of life at a center should be good. At center retains highly paid professional from own country as well as from outside. Rational regulatory framework, here rational regulatory legal regulatory framework is another prerequisite of international financial center, as it should fair and transparent. Sustainable economy, so the economy should be sustainable and should possess capacity to absorb all shocks, at it will boost the investor confidence. Now we need to know about the green gift city in Indian international financial service centers. So where it is there to compete with the rival financial services, where the rival financial services is situated, that is Dubai, Hong Kong, etc. So to compete with that person, the idea of setting an international financial centers in India was coined in 2007. The main motive of setting up IFCs in India was to retain financial service businesses in India which move out of the India. So who is the persons going for outside India for getting more money, they will try to establish here itself. Here, since foreign investors normally remain hesitant to get registered in India, Gift City provides them a separate jurisdiction where it is easy to do business because relaxed tax and other provisions. So what the foreigners will come, and after the coming they will hesitate to register in our process, because our government persons are not give the proper guidance and not give the proper terms and conditions and not provide the licenses fastly. So that persons who are entering into this country, the government now provide this gift city providers. So for that persons whoever the foreign investors is coming, they will provide some separate jurisdiction and they will allow some relaxed tax provisions also they will provide. Here accordingly, Government of India operationalized institutional financial centers IFSCs at Gift City Multi Services SEJ in April 2050. The Union Budget 2016 provided competitive tax regime for IFSCs, that International Financial Service Centers, in as a gift SEJ. That is SEJ means security. SEJ means special economic zone. So same like as special economic zone, they are providing this IFSC. They are giving more benefits. If we see in income tax, MAT and AMT we will calculate now. For that AMT, MAT and AMC, for this IFSCs they have different rates, that is less rate they will give, and with the objective of achieving sustainable growth. So sustainable growth and achieving stated objectives of Indian Honorable Prime Minister is inaugurated Indian first international exchange in India INOX, or wholly owned subsidiary of Bombay Stock Exchange. Indian INOX has started trading in index, currency, commodity and equity derivatives. So on 5th 2017, NSE as the competitor of Bombay Stock Exchange also launched at trading at Gift City. Here initially it started trading in derivative products, equity, currency, international interest rate, futures and commodities. After that, Gift IFSC provide very competitive cost of operations with very competitive tax regime and single window clearance. So they need to follow single window they will provide, and a relaxed company law provisions, international arbitration center with overall facilitation of doing business. Here Gift IFSC is now moving towards unified regulatory mechanism. Now Gift City is new financial and technology gateway of India for the world. To be internationally, exchange controls cannot apply. So FEMA is not applicable at Gift City. So for the Gift City, the FEMA province will not applicable. FEMA province is applicable now. For that foreign exchange monies will affect. They will need to get the more regulations, operations, and they must follow the authorized dealer. They will go whatever the transaction they want to do, they will go through only through authorized retail. These all complications will be there in FEMA, so that FEMA will not applicable to this gift city. Hence, with all this development, more and more financial institutions or set business units in gift as they will pay reduced tax as valid for special economic zones and can easily offer foreign currency loans to Indian companies abroad and foreign firms. After that, sovereign funds. Here, sovereign funds means a sovereign wealth fund is state owned investment fund. So who will own these funds? State owned. The AP government or Tamil Nadu government or Telangana state government, they will own this investment funds will compromises of money generated by the government. This money generally derived by government from country's own surplus reserves. So it has government own surplus reserves. So the sovereign wealth funds provide benefit for country economy and its citizens. So since it is created by government, the legal basis on which these are created varies from government to government. So AP funds is different, Telangana funds is different, Tamil Nadu funds is different. Different will be there. So legal basis of created various government to government. So the legal basis for sovereign wealth fund can constitute law, physical law, and constitution, company law, and any other law and regulations. Here, popular sources for funding of sovereign wealth funds are surplus reserve from state-owned natural resources, revenue, and trade surplus. So for government, if the government has any surplus, they can transfer that surplus to this funds. So almost all states as of now will have in debt, they do not have more surplus. Next, bank reserves that many accumulate from budgeting excess. So bank will reserve the may accumulate from budgeting excess. Next, foreign currency operations, money from privatizations and governmental transfer payments. Generally, this sovereign wealth funds are created for targeted purpose. Through some countries have created sovereign wealth funds like venture capital for the private sectors. Some of common objective of sovereign wealth funds. So venture capital means we will invest in these startup companies. Startup companies will grow, they will get the more money, and they have some objectives. What are the objectives? Protection and stabilization of budget and economy from excess volatility in revenue or exports, or diversify from non-renewable commodity exports. So where they need to budget will be stabilized. So budget will be stabilized. So whatever the budget they are providing now, that budget is stabilized. And another one, diversify from non-renewable commodity exports, or earn better return than returns on foreign exchange reserves. Assist monetary authorities despite unwanted liquidity. Next, increase savings for future generation. Fund social and economic development and ensure sustainable long-term capital growth. This is the main objective. And political strategy, these are the objectives will be there for these sovereign funds they will use. And other type of investment funds, the sovereign bonds can have their own objective also, which have risk tolerance, terms, and liquidity concern. While some funds prefer return over liquidity, and some may prefer vice versa. So liquidity means it is provide the facility to easily convertible into cash, and illiquidity means it will not easy to convert into cash. So if you are invested in private equity fund, it will illiquid. If you invested in mutual funds, it may be liquid funds. And depending on the assets and objectives, sovereign wealth funds risk management can range from very conservative to high tolerance. Here, what is meant by conservative? Means conservative or aggressive. So conservative means where if you have 100 rupees amount, so if you are 100 rupees, this amount you are invested in source, means 60 rupees in debt, 40 rupees in equity. It is conservative plan. Aggressive plan means if you have 100 rupees, that 100 rupees you are investing equity is 60 and 40 will be the debt. So when you are using more equity, it is aggressive plan. When you are using debentures, this conservative plan. So So what is the objective of sovereign wealth fund? It is conservative plan. They don't want to take much risk. Stabilize the funds and saving future generation funds, public benefit pension reserves, reserve investment fund, or strategic development growth fund they will use. So they will use the various type of investment vehicles. It is separate means SPV there not that type of SPV they will use. One is sovereign wealth funds vehicle, public pension fund vehicle, state owned enterprise vehicle, and sovereign wealth enterprises. After that, international working capital management. I think how much is there? Just a second. 30 pages. Okay, complete it. So international working capital management. The management of working capital. Working capital means operating to meet the operating whatever the amount we are using, that is working capital. So to manage that working capital of international firm is much more complex as compared to domestic one. Why? The reasons may be, one is MNC firms will have current assets, so wider current assets will be there, so that these MNCs will have in international financial market, they are dealing with international financial market, they will go with the local currency. Majorly they will go with the local currency and for global currency, and the opportunity for domestic firms does not have. That is one problem. And another problem will interest plus tax rate is the another problem. And another problem will this foreign exchange risk is there, foreign exchange risk will be there. And after that, some host countries will restrict to convert or restrict to take that amount whatever we are earning na, that amount they will provide some restrictions, or some cases we do not have the political knowledge. This is also one problem. And one is they MNCs will not provide full capital convertibles. These are all problems will be there. So firstly, international working capital management for the complex issues. So what are the complex issues? One is multinational firms has wider option of financing its current assets, so they will go with the current assets. So this MNCs has fund flowing from different parts of international financial market, therefore it may choose to avail financing either local or for global financial market. So opportunity does not exist for pure domestic firms. Next, other problem will be interest and tax rate may vary from country to another country. So a treasurer associated with multinational firms has to consider the interest or tax rate differential while financing current assets. This is not the case of domestic firms. Next, multinational firms is confirmated with foreign exchange risk. So foreign exchange risk will be there, where inflows outflow of funds as well as value of import or export influenced by the exchange rate variations. Next, restrictions will be imposed from home or host country towards movement of cash and inventory of account political consideration, which will affect the growth of MNC. So this restrictions, the government will restrict the money flows, that will affect the companies. Next, with limited knowledge, with political and economic conditions we do not have much knowledge of that country, then it also affect our working capital amount. In countries which have operating full capital convertibility, MNCs moves its fund from one location to another, then the mobilize and position of the fund is the most efficient way possible. Such freedom may not be available for MNCs operating in countries that have not subscribed to full capital convertibility. And a study of international working capital management required knowledge of multinational cash management, international inventory management, international receivable management also there. Next, multinational cash management means overall overseas wise we need to manage our cash. How can we manage it? How can we manage the cash will be required. So for effective way of cash management we need some objectives will be followed. One, effectively manage and controlling of cash resource of the company as well as achieving optimal utilization and conservation of fund will be required. So this is main objective of any company. So they need to want improve cash collection and disbursement, and they make an accurate and timely forecast of cash flow patterns. So what are the objectives can be reached by the
making money available as and when needed, minimize cash balance level, and increase the risk adjusted return of funds that is to be invested. Now we need to see international cash management. For international cash management requires multinational firms to adhere to the extent rules and regulations in various countries that they operate in. So apart from these rules and regulations, they would require to follow relevant forex market practices or conventions what they are providing practiced in their parent country. A host of factors curtail the areas of operations of international money manager. Example, these restrictions on FDA, repatriation of foreign sales proceeds to the country home country within a specified time limit, or problem of blocked funds. Such all restrictions will be there for this cash. So main objective of effective system of international cash management is minimize currency exposure risk, minimize overall cash requirement of without disbursing, smooth operations, minimize transaction cost, minimize country political risk. So international cash management, it will decrease the cash transaction cost, country political risk, take advantages of economies of scale. Economies of scale means what? Economies of scale means if you have one employee, if it is a manufacturing business, so learning curve will be there. Learning curve means here what is this learning curve? For employee, at the first time he is doing the work without having knowledge, he will take 1 hour, that is first time case, and after some time he may take, it will be maybe 45 minutes, or after some days he may take 30 minutes. This is there for learning curve effect will be there. Economies of scale, or you can buy the goods at bulk basis, you can get the benefit. Or the centralized cash management group is required to monitor and manage parent subsidiary and inter subsidiary cash flows. So centralization of information, reports, and decision making process relating to cash mobilization, movement, and investment. This system benefit individual subsidiaries which require funds are exposed to exchange rate risk. Now centralized cash management systems will help MNCs as follows. So maintain minimum cash balance during the year, manage judicially liquidity requirement of the center, optimally use various hedging strategies so that MNC's foreign exchange exposure is minimized, to aid the center to generate maximum return. So they will see maximum return, they will generate investing all cash resources optimally, aid center to take advantage of multinational netting so that transaction cost and currency exposure are minimized, maximum is utilization of transfer pricing mechanism so that the firm enhances its profitability and growth, exploit currency movement correlation. So what is the payable and what is the receivables in different currencies having positive correlations? What is the payables of different currencies which have negative correlations? We will see pooling of funds alone, reduced holding we will consider. For example, if you have MNC, two subsidiaries is there in different countries, one is in America, one is in London. So the two subsidiaries periodically send fees and dividends. So they need to send fees, dividend to pay parent as well as send excess fee, all of them representing incoming cash to the parent, which while the cash outflow to subsidiaries including loans and returns on cash invested by them. So as a subsidiary purchase supplies from other country, they have cash flow between themselves also. Now we need to see the one chart they are provided for entire overall cash flow. So here first what we have, one parent is there, so one parent will be there. So what are the options will be there? From parent, here two subsidiaries there, one is subsidiary A, another one is another subsidiary, and here from the parent what they may go here, it will start now. So this subsidiary may give loans to this and give funds to for suppliers, they need to fund for suppliers other funds, and if they have any excess cash they need to provide, if they have excess cash to be invested here itself, and here the parent will invest this amount in subsidiary. Firstly they will invest now, and here also the parent will invest, and fee and part of earnings will be there, and this is the this side. And after that, then the amount these subsidiaries will take the loans, whatever the interest and principal on excess cash invested by subsidiary, that also transfer this one. Now they need to purchase some securities short term, and they will funds received from sales of securities. If they go for the long term, this will be long term, and they will take loan from other banks, and they need to repay, and funds paid for new stock issues and source of debt. So cash dividends will be there. This is the overall cash flows for MNCs will be there. Here optimum cash international cash management has two basic objects. One is optimizing the cash flow movement and investing excess cash flows. This is the main objective. So, and no single strategy of international cash management can help in achieving both these objectives together. It tasks on such aspects become very challenging. So there are numerous way will be there for optimizing the cash flow. So optimizing means what? Decreasing the cash flows in between the internal countries. So accumulating cash inflows, managing the blocked entities, leading and lagging strategy. This leading and lagging strategy and means leading means before market knows, before trend come into the picture, we will assume this is the going to the future. Lagging means already the market is there, that idea we are late to know about that idea. Minimizing the tax and cash flows through international transfer pricing, and using netting to reduce overall transaction cost. So if the parent is payable is there, and if the subsidiary is receivable there, we will use this net amount, we will eliminate the full cash flows. And investing excess cash flows, if the subsidiary has any cash flows, they will give allow the person to invest in other company. Next, accelerating cash flows. Accelerating cash flows means faster recovery of cash inflows, help the firm to use them whenever required or to invest them for better returns. Here customer if using checks for making payments or all over the world are instructed to send their payment to lock boxes set up at various locations. So they the customers will not go to the bank, they will kept some boxes in different locations. If the customer want to give any checks, then they will post that boxes. It is like a post box in different location is there na, they don't want to come the post office, they need to post that in that post box, and these companies will take from that checks from that post box different details. So pre-authorized payments and organization may allow to charge customer bank account upon some limit. Managing the blocked funds. So blocked fund means we are say that that funds which have some tax free or DTA agreements, to get that benefit the master fund will register another fund which is equivalent power to master fund. The host country may block funds of the subsidiary to be sent to the parent, or make sure that earnings generated by the subsidiary be reinvested locally before being remitted to the parent. So here he have the blocker will have powers to reinvest. It is not sent to parent and parent will invest. They will tell the company's name, they will invest in that companies. So then the jobs are created and unemployment will reduce. The subsidiary may be instructed to obtain bank finance locally from the parent firm, so that blocked funds may be utilized to pay off the bank loan. The parent company has to assess the potential of future fund blockage in the foreign country. MNCs have to be aware of political risk cropping up due to unexpected blockages of funds, and devise ways to benefit their shareholders by using the different methods for moving blocked funds through transfer pricing strategies, direct negotiation, leading and lagging hands on. And leading and lagging strategy means this technique is used by subsidiaries for optimizing the cash flow movement. So they will see optimizing cash flow movement by adjusting the timing of payment to determine expectation about future currency movements. MNCs are accumulated means lead means we will have future, and or delay means lag. The timing of foreign currency payment through adjustments of the credit terms. Means leading means we have in first place, lagging means we have in last place. And for currency payment through adjustment of credit terms extend by one unit to another. These techniques help to reduce foreign exchange exposure or increase available working capital. From accelerate payment of hard currency payables and delay payment of soft currency payables in order to reduce foreign exchange exposure. Suppose MNC in the USA has subsidiaries all over the world. The subsidiary in India purchases its supplies from another subsidiary in Japan. If the Indian subsidiary expects rupee to fall against the yen, then it shall be objective of that firm to accelerate the timing of its payment before rupee depreciated. Now, the different strategies leading means we know the currency is going to fall before it falls. That is because of we use the some technology or we use the some trends. By the trends or technology we assume market will be going down. Before market going down we can know the symptoms, that is leading. And on the other hand, Indian subsidiary expect the rupee further to be stronger against the yen, then it shall be objective of the firm to delay the timing of the payment. So rupee may depreciate or rupee may appreciate too, but we are assuming one but it is happening other. We are not yet updating as per the market terms, it is lagging. MNC should be aware government restrictions in the such country before awareing such strategies. Next, minimizing the tax on cash flow through transfer pricing mechanism, TPM. So by using TPM we can minimize the cash flows. Here, large entities having many divisions require goods and services to be transferred frequently from one division to another. The profits of different divisions are determined by the price to be charged by the transferor division to the transferee division. The higher the transfer price, the larger will be gross profit. So what will be there? Gross profit will be higher of the transfer division with respect to transferee divisions. The position get complicated from MNCs due to exchange restrictions or inflation difference or import duties or tax rate difference between two nations or codes imposed by the host country. Or netting means we cannot take the gross amount, we will take the net amounts. If your company has trade payable, company has trade receivable, after netting we will take. So for example, net trade payable is there 400 rupees and when we trade receivable we have 1000 rupees, we will net off and we will get only 600 rupees. And some companies will go with they will take 400 and they will give 1000, it is overloaded. So here for using this advantage netting, the reducing the number of cross-border transactions, so it will decrease the cross-border transaction between subsidiaries, they decrease the number of overall administration cost of such cash transfers. Next, reduce the need for foreign exchange conversion and hence decrease transaction cost associated with the foreign exchange conversion. Next, improve the cash flow forecasting since net cash transfers are made at the end of the each period. New year gives an accurate report and settles amount through coordinated efforts among all subsidiaries. By netting we have two types. One is bilateral netting and another one is multilateral netting. Bilateral netting means here the transactions between the parent and subsidiary and between the two subsidiaries, or if the subsidiary X purchased 20 million worth of goods from subsidiary Y and subsidiary Y in turn buy 300 million worth of from subsidiary X, then the combined flow add up 50 million. But in bilateral netting, from subsidiary Y should pay subsidiary X only 10 million. Thus bilateral netting reduces the number of foreign exchange transactions, also the cost associated with the foreign exchange conversion. Whereas multiple netting system means here each affiliates means different subsidiaries we will call as affiliates. Nets all its inter-affiliates receipts against all its disbursements. If transfers or received balance are in position, it being net receiver or payable through by resulting in saving in transfer or exchange cost. For an effective multilateral netting system, there should be centralized communication system will be required. So head office will discuss. So for X company and Y company and Z company, different company is there. So this company want to tell the transfer this amount will be transferred to this company. So they will see the company. So here company P P is there, sell 500 worth goods to subsidiary X. Subsidiary X sell 500 worth goods to subsidiary R. Subsidiary sells 500 worth of goods to subsidiary P. So here P to Q, for example, here what will happen? P to Q means Q is payable and Q to R means R is payable. So here P and here Q is payable and R is payable. R to P means here P is payable. So they will sell. So you don't pay this person and you don't pay this person and you don't pay this person. Completely eliminated. This is relating to this one. So here they provided some. The netting system uses matrix receivables and payables to determine the net receipts or net payment position of each affiliate at the end of the date of clearing. US parent company has subsidiaries in France, Germany, UK and Italy. The amount due to and from affiliate is converted into common currency US dollars. So paying the affiliates, netting the shed affiliates. Next, investing excess cash. So euro currency market accumulate excess cash in international money market euro dollars. So depository offer MNCs higher yield. So if the country, our bank is giving 7%, in other country they will giving more interest rate. So we will tell that you can invest in there only, and you can use that amount, temporary funds, purchase of treasury bills or commercial papers which does not have risk and where return is high as compared to our country, different countries. So centralized cash management system strategy will be useful for this. And international inventory management means we can use the bigger stock content EOQ. The process has known as stock piling. So stockpiling, the different units of a firm get large part of in their inventory from sister units in different countries. So this is possible vertical set of, and due to political disturbances, though there may be bottleneck in imports. So if the currency of the importing country depreciates, import may will be costlier. So they will transfer they will use the interfirm stock, they will transfer. International receivable management means if we sell in one country, the other country person, our branch is there in that country, they will get our money. This is international receivable management.